In this presentation, we will take a look at the possible adjustment for AGI, adjusted gross income, related to alimony paid. We are concentrating for the tax equation on the second line, the deductions for adjustments to income, or the above-the-line deductions, or the Schedule 1 deductions as compared and contrasted to the standard and itemized deductions, which would be down below. Where is that going to be on the tax return? The 1040 page 1, line 8A, adjustments to income from Schedule 1. And if we then pull that number, will be coming from the Schedule 1. Here's the Schedule 1 Part 2. We're going to concentrating here on line 18A, where we have the alimony paid. Notice when you're thinking about alimony, what we're talking about is a situation, typically we have a divorce that would happen. Part of the divorce agreement would then be possibly alimony, and child support are the two types of payments that could be a result of a divorce agreement. And therefore, you're going to have that. We'll talk a little bit more about that in a second, but you're going to have that payment information. Now, if you're able to have a deduction related to alimony, then of course the IRS wants the information related to the spouse here. So you're going to have the recipient's social security number as well. So any kind of deduction, you'll recall, any kind of deduction that someone's going to take, the IRS typical position will be, if we're going to give you a deduction, you need to tell us, report to us in some way, shape, or form who got the money, because typically whoever got the money is who the IRS wants to collect the tax from. So in this case, if you're talking about alimony, if the person paying alimony gets to deduct it, the IRS wants the social security number of who you paid the alimony to, because they expect the income to be coming from whoever got the money. So let's think about alimony, what alimony is, and what are the rules related to reporting alimony. They have changed. So there's going to be some, and when you have a change like this, oftentimes you have to kind of draw a line and say, well, anything that happened before this time period is going to be under the old laws, and anything after this time period is going to be under the new laws. So if the law takes hold for a long period of time, it should make things kind of easier at that point. But us as tax preparers at this point in time have to deal with that line and say, all right, what are we dealing with? Are we dealing with something that happened, an agreement that happened before this time or after this time? Now, if we're dealing with a continuing client, then it shouldn't be a big deal, because hopefully we can do the same thing that we've done in the past. We've already had the agreement was in place. If there's no changes to it, we can keep pushing forward. However, if there's a current divorce and a new agreement that takes place, then we would know that at this point in time and need to be mindful and aware of the new rule that would be applied at this time. So starting in 2019, alimony is not deductible by the payer and is not included in income by the recipient. In order for that to make sense, you got to understand the old rule. And the old rule was that if there's a divorce agreement and something was categorized as alimony as opposed to something else, in other words, a payment is happening in the future after the divorce, which isn't part of the initial divorce or separation agreement, but is part of payments in the future after the divorce has happened from one spouse to the other, they can typically, those payments, be categorized as either child support or alimony. If it was categorized as child support, then there's no deduction by the payer, and the recipient wouldn't have to report it as income. If it was categorized as alimony, however, the person who is paying it gets to have a deduction, and the person that receives it would then have to record it as income. So this law is then saying, it doesn't really matter what you record it at after this point in time. The IRS is going to basically step out of the divorce agreement, which may be a good thing after time, because then you don't have to take into consideration the tax consequences from one to the other, and then the classification of something between child support and alimony is not as big a deal. However, if the agreement had already been made and they had taken into consideration the tax consequences and everybody is happy with the agreement that has happened, you don't want to stir that up. You want to keep that in the way it is. And any new agreement, you can take that out of the picture, which will hopefully make the divorce settlement process easier for new divorces and not mess things up for agreements that have already been in place in the past. For us as tax preparers, then, we need to know where that line is. We need to see when the old rules still apply, which we can follow still the old rules, and when there's a new divorce that would then be happening, then having the rules for the categorization under the new rules. New rules apply to divorce or separation agreements after December 31st, 2018, and could also affect agreements that have been modified after that date. So note that we have the new divorces that might happen after that point in time, and then we'd have to apply the new rules. But also if there's a modification, you got to be very careful about the modifications that are happening and make sure that you're taking into consideration the new rules and the possibility that there's going to be a change to the way the taxation works under the new rules, under a modification of a divorce that happened prior to the cutoff date. Agreements that were executed on or before December 31st, 2018 that were not subsequently modified after that date would basically be under the old rules, where payments can be deducted and receipts are included in income. So let's think about that a little bit more in depth. Note that if you're the tax preparer, hopefully, if it's a continuing client and they had alimony between them prior to that, you can kind of consider the old rules. You would think the old rules would still apply because the agreement had already been put in place, and you would think that if nothing had changed, you can go on just as you would in general. However, if you have a new divorce that happens, then you want to make sure that you take into consideration and change your mindset in terms of the payment allocations related to alimony, because the IRS would basically step out of it. No matter what the payments were, then you're not going to have the tax consequence that you would have had if the prior divorce agreement was in place. So when you think about the divorce agreement, there's kind of three kinds of payments that could happen between the spouses. One, alimony; two, child support; and then three, the property settlement. So in other words, if you had two individuals that the IRS basically thought as one with regards to their assets and the income that they're going to be reporting on it, and they separate, then the separation agreement, those assets going between the one kind of joint group to the two groups, is a property settlement. There's no income happening there because they're just deciding how to split up what was once one and now two. So no income is happening. There's no payment from one person to the other. So there's no tax consequence that would happen with the initial settlement on who gets what type of thing. And then if you're talking about future payments, then you're talking about typically one of these two. You've got the alimony or the child support. Now, prior to this, it was way more important to have this categorization and kind of more complex, because if something was categorized as alimony, then there's a tax effect. And the person that pays the alimony would want that to be the case, because they would then get to deduct the alimony. The person that receives the alimony would then have to include it in income. So the person that receives the alimony would not want it categorized as alimony. They would want it categorized as child support. And then if it's categorized as child support, the person that pays the child support then would not be able to get the deduction, but the person that receives it and the person that receives it doesn't have to record it in income. So under the old rules, there, you would think there'd be an argument, or there could be some debate as to whether the person who's paying would like to be calling it alimony so they get a deduction, but the person who's receiving it doesn't want it as alimony because then they'd have to record it as income. And if it was child support, the person that's paying doesn't want child support. They'd rather have alimony because they don't get to deduct child support. But the person that's receiving wants child support because then they don't have to record it in income. So under the new rule, basically, there's no tax consequences under either one, and therefore, hopefully, it'll be easier to kind of figure out what the divorce settlement will be if there's no kind of tax consequences on the payments between spouses on the future, whether they be alimony or child support. So alimony is the only one that could have tax consequences. And so under the old rules, alimony had tax consequences and the child support didn't. Under the new rules, then you may not have the tax consequences for alimony or the child support. So alimony is the one in question. So if you have a divorce agreement, if it's child support, you're going to say, well, that's not something included in income and you don't get a deduction for it. If it's alimony, then you're going to say, well, it may have to be included in income and you may get a deduction for it if you are paying for it. So the requiring of one spouse to make payments to support the other spouse, what is alimony? The requiring of one spouse to make payments to the other spouse, so the payment are happening in the future. They must be in cash, so we're talking cash payments, must be required under provisions of the divorce agreement. So you can't just make a payment and say that's, I'm categorizing that as alimony if it's not part of the settlement of basically the divorce agreement. Payments must end at the payee spouse's death. So, and this is often the thing that used to be the consideration. You would think under a divorce agreement that they would make this very specific and clear. Hey, this is an alimony payment. This is a child support payment. But under the legal terms, they often don't make it as, very clear on that. They use kind of legalese language. And if you were actually to look into the divorce agreement, you'd have to say, well, is this divorce, is this child support or alimony, and make some type of determination on it. One determination you can make on that, if you had to, is you'd have to say, well, do the payments continue after the death of the spouse? Or, because if they did, then clearly it's not to support the spouse. You would think that might be for the child support. So that's one kind of differentiation characteristic we might use. Again, the new law hopefully will make that a little bit more clear, and we won't have to go through that kind of legalese type process to distinguish between the child support and alimony, at least for tax consequences.